Good afternoon, everyone, and thank you very much for joining us today. My name is Joe Litchower on the Kepler Trust Intelligence team, and today we're going to be diving into the fascinating and at times complex world of China. In a moment, we'll be hearing from Ben Buckler, investment specialist and chair of the China Product Group at Baillie Gifford, who will be sharing some thoughts on the overlooked opportunities within China and its potentially changing narrative. For those of you new to the format, here's what to expect. Ben will speak for around 20 to 25 minutes, giving an overview on the current backdrop in China, but also its outlook. And after that, we'll move on to a bit of Q&A, and that should last around 15 minutes or so. If you do have any burning questions you'd like me to put to Ben, whether trust-specific or on the broader China landscape, please do drop them in the Q&A box on the bottom right-hand of your screen, and we'll try to cover as many as we can at the end. So with that, Ben, it's an absolute pleasure to welcome you. Over to you.
Thank you very much, Joe, and good afternoon, everybody. Thank you for having me. This series of events is called Dividend Heroes and Growth Giants. So it may not surprise you when talking about China today that the spotlight is firmly going to be on those growth giants. And let me start with a quote that I heard from the chief executive of a major European multinational. "If you want to see the future, go to China." And that line sort of stuck with me. I've just come back from China myself. I was there last week. And in many areas, the country that once followed the world's playbook is now starting to rewrite much of it. And for us at Baillie Gifford, our approach to investing involves taking that long-term approach, which requires thinking very deeply about what the future might look like. So when it comes to seeing the future, it's really quite vital that we consider what is happening in China. Earlier this year, Chinese social media exploded with a video of a Xiaomi SU7 car you see on the left there. Xiaomi, most people would know for being a budget smartphone maker. But it now is a car that raced past a Porsche Taycan on a test track. And the real disruption wasn't the speed of the car, it was the software that it came with. So a voice-activated AI assistant, a TikTok-style dashboard, and a user experience that makes legacy car brands look pretty dated. And then after that came the real headline grabber, because out of the car stepped the chief executive of Ford, who called it a wake-up call and the most humbling thing that he'd ever seen. And that's the new reality. China's no longer playing catch-up, and in some areas, it's really setting the pace. As you may have seen with an autonomous robot running a half marathon in Beijing earlier this year. And while I certainly wasn't keeping pace with autonomous robots running half marathons, I did find myself on the Great Wall of China, all hot and sweaty, when an executive from Meituan, so China's leading food delivery company, suggested sending a drone with a cold beer. I guess for me, that was just quite a good way of reminding me that innovation in China isn't theory, it's everyday life. That mindset of faster, smarter, constantly improving, it's running through China's tech scene, which is no longer just about cheap labor anymore. It's about scale, about speed, and about software. So China is the world's second largest economy. It's proved itself to be far more innovative than many believed was possible. The size of its markets, the scale of its ambition, are now starting to deliver world-leading companies in sectors that are going to be critical to us all in coming decades. And yet, to counter that, for every leap in innovation, there are equally significant concerns. State control, regulation, governance, geopolitics on top of that, and I think ignoring these would be just as dangerous as ignoring the opportunities. So hopefully over the next 15 minutes or so, I want to navigate this challenge and then point to how Baillie Gifford's China Growth Trust seeks to find the most exciting companies in China whilst trying to minimize some of the broader risks of investing there. Let's just rewind to last year. China is uninvestable, was the headline. 3 years of weak markets, poor sentiment, and policy uncertainty spooked quite a lot of investors, and when markets go down, everybody looks for reasons as to why. Then fast forward to today, and China is one of the best performing markets globally over the last 12 months. And suddenly everybody is now looking for reasons as to why it's going up. What's changed? This slide sort of picks up on three key worries from last year: the domestic economy, regulation, and geopolitics. And I'm going to argue that two of these three headwinds have shifted meaningfully over the course of the last 12 months. To start with the economy, China's weathered a tough few years. Zero COVID disruption, the property slump, that's hit local government debt, and that's hit household confidence. Many in the market thought that Xi Jinping's ideological approach meant that this sort of economic growth was being sacrificed for national service. But things are changing. Xi has been far more pragmatic than many expected. Last year in September, we saw a coordinated support for the economy. This coordinated is quite important because it means that the vision came down from the top, aligned with the regulators, the economic bodies, to try to drive growth. And yes, China still has challenges in its economy. But just this quarter, we've seen the new 15th five-year plan, and that makes very clear that growth, innovation, and consumption are critical to China's development. Second, when it comes to regulation, between 2020 and 2022, the tech crackdown really hit quite hard. And again, it was seen by many as being anti-private companies. Certainly newspapers were quite quick to highlight the role of the state. But it wasn't ideological, it was much more cyclical. Given the speed that China has been innovating, it's perhaps not a surprise that the government wanted to rein in some of those abuses. What it also does for us is highlight just how an alignment with societal goals is really quite a critical part of investing in China. We should think of regulation much more like a pendulum, swinging between innovation and regulation over time. And right now, that pendulum is swinging back in support of innovation and in support of the private sector. The best evidence we have from that, aside from the companies that have been telling us this for probably the last 18 months in terms of the change in government regulatory environment towards being supportive of growth, CapEx, R&D. But it was the visible meeting between Xi Jinping and the tech founders that happened earlier this year. And then finally to geopolitics, where I think we just have to recognize that this is going to be an ongoing challenge. It'll ebb and flow, but we expect tensions with the US to remain, in part because, as we'll come on to later on, China's innovation is starting to become a competitive threat. So we'll hear a lot about tariffs, we're going to hear about Taiwan, sanctions. And as investors, we certainly can't ignore the impact that this can have on both sentiment and on share prices. But again, here, perspective really matters. Chinese exports to the US make up less than 3% of GDP. China spent decades building trade resilience, and that's accelerated since the first Trump administration, but it's been signing regional deals, investing in infrastructure, deepening these supply chains, particularly across Asia, Africa, and Latin America. So if we're just focused on the newsworthy titles of tariffs, then we're probably focusing on the wrong area. And that's worth remembering when looking and weighing the long-term potential against some of this short-term noise. And if we look at some of these long-term trends, we can start to see quite an interesting picture. As you see on the left here, back in 2000, the US was the top trading partner for most countries. By 2024, that's been a huge shift to China, which is now the leading trading partner for more than 145 nations, signaling quite a huge shift, not just in economic, but also in political influence. Trade over that period with China has grown 13 times since 2000. Again, that's not cyclical, there's something structural here. As China's manufacturing base has moved steadily up the value chain, they're producing higher value-added goods from EVs to advanced electronics. And that's really based on having leveraged its competitive cost structure, its huge scale, and also that fast-growing domestic market to be able to anchor itself in global commerce. So while yes, exports still matter, the growth engine in China is shifting to its domestic economy, to things like consumption, innovation, and also self-reliance increasingly. So what's really going on in that domestic environment? What's happening in China's economy? We're in the middle of a structural transition, a shift from what was build and export to now what is becoming create and consume. So that old model that many of us know well of infrastructure booms, real estate, state-owned giants, that's run its course, and China's now attempting to make this shift and make consumption an economic and a political priority. And as we see, this isn't going to be easy. It's not painless, but we are increasingly having to recognize that the private sector plays an absolutely critical role in this, and the numbers on this slide show you why. The private sector is 60% of GDP, 70% of tech innovation, and 80% of urban jobs. So to get to where China wants to get to in its development, Beijing knows that it needs the private sector. And again, that handshake on the right-hand side there between Xi Jinping and Jack Ma earlier this year symbolized this softer stance, this idea that innovation isn't the enemy, it's the engine of China's growth. So growth ahead will come less from smokestacks and skyscrapers as in the past, and more from things like services, software, and scale. And as I think we saw earlier this year with a little bit of help from DeepSeek, but the world is just waking up to the strengths that China has in just the sheer levels of innovation in many areas of its economy. This slide here just looks at some of those areas of underappreciated innovation. Because when many investors think about China, they picture cheap exports, t-shirts, toys, maybe low-end electronics. But that story is increasingly outdated. China is today all about value added and moving up the technology curve faster than most people realize. Let me just give some data to sort of back that up. China now produces around 60% of the world's electric vehicles and over 75% of the battery capacity that goes into them. China's built more 5G base stations than the rest of the world combined. Again, laying the foundation for things like autonomous driving, smart factories, and smart cities. And then last year, China added more industrial robots and more semiconductor capacity than the rest of the world combined. So it's no longer about copycat manufacturing. It's a system that sort of maximizes top-down policy, bottom-up innovation, and critically scale. So again, going back to these ideas of automation, digitization, consumption, climate transition, the list goes on and on. China is building companies that are set to dominate some key global themes in the next decade or two. Don't we want to be invested in the companies that are shaping that future? I'm not sure how many of the companies on this list our listeners here today will have come across. These are Chinese companies already leading, many of them globally. And when the conversation on China often stops at debt or property or state-owned enterprises, we'll acknowledge that these issues exist, but that's not where we invest. We're focused on the structural growth stories. So today I just wanted to focus on three particular areas to try and give a flavor for the kind of areas of excitement that we see. First, in terms of the super apps. When people think about Chinese technology, they often picture hardware. But the real story starts with China's software ecosystems, what we call these super apps. Think of Tencent with WeChat. It's not a chat app, it's WhatsApp, it's PayPal, it's Amazon, and Facebook, all of those rolled into one. Then there's companies like ByteDance, the parent company of TikTok that you may well know, a global entertainment phenomenon in recent years that's completely reshaped how we consume content. It's also, for reference, the Trust's second biggest holding and one of the two unlisted companies that we have in the Trust. And then Pinduoduo, better known overseas through its app Temu, which has reinvented online shopping with gamified social buying. Put these together, it actually surprises quite a lot of people when I mention that 4 of the top 10 apps downloaded in the US today are Chinese. which I think is just an incredible reminder of just how far China's digital platforms have come. Then we'll have a look at the green transition and the leaders there, where China really is playing a central role in the shift to clean energy and smart mobility. So EV maker BYD recently overtook Tesla this year as the biggest maker of EVs globally. Some of you may have seen more and more BYDs on the road here in the UK. The UK is now its largest overseas market. Then going further up the supply chain, CATL is the world's biggest EV battery manufacturer. It supplies about 40% of all EV batteries globally. And then Horizon Robotics, which I guess many people won't have heard of. It's pioneering autonomous driving chips. And in fact, when I was in China, I spent 45 minutes being driven around Beijing, one of the craziest cities for driving in the world, without a driver, in a car powered entirely by Horizon's technology. So these companies, again, aren't following the green trend, they're really defining it. And then finally, on the consumption side, and we often hear quite a lot about Chinese consumption. If you want to understand China's consumer power, let's look at the scale that China has. I mentioned earlier on, Meituan is the country's food delivery giant. Here in the UK, Deliveroo delivers around 1 million meals a day. Meituan hit 150 million deliveries on its peak day earlier this year. Then we look at something like Luckin Coffee, which has overtaken Starbucks in China, has built a data-driven model that's reshaping how people buy their morning coffee. And Midea, a brand not necessarily widely known, but it's the invisible hand behind many of the famous branded household goods that we see today. Again, a global technology leader in the era of smart living. So, altogether, these aren't the legacy industrials that many people talk about. They're scalable, tech-enabled, consumer-focused businesses that you might not have heard of, but which are leading in their fields. And here's a fun, but I think quite a telling example of China's consumer shift. On the left, obviously, Mickey Mouse, a global icon for 100 years. On the right, La Bubu, created by a company in Beijing called Pop Mart. Pop Mart's limited edition boxes sell out in minutes. The stores have huge queues down the block. And the brand has grown from its early days as making blind box toys now to a full lifestyle label. So to some extent, think Disney in the 1950s, but built for this TikTok era. And this isn't just about toys, it's about China moving back up the value chain. So we've talked about EVs and AI, but here it's evidence of China moving up in IP, in design, and in global consumer branding. So yes, it's a bit of fun. Mickey versus La Bubu might sound playful, but what it does signal is something real. Some of the next global icons might not come from London or LA, they could come from Hangzhou or Chengdu in China. Don't we want to be as investors, don't we want to be ahead of some of those kind of trends? So let me move on then from culture towards capital. What you see here on these two tables is the huge disconnect between China's global role and its position in portfolios. And I think this is an anomaly that should raise questions. China makes up 18% of global GDP, and yet global investors have more money in one stock, in Apple alone, than they have in the entire Chinese market. To us, that's extraordinary, particularly when you're looking for growth giants. Because if you take all of the companies in MSCI ACWI, the global universe, forecast to grow 20% a year over the next 3 years, over 30% of them are Chinese. Again, this mismatch between economic reality and market allocation is where our opportunity lies. But to move towards a conclusion here, I think to get there, we need to reframe our thinking. In a world in which one lens tends to dominate, that one that delivers the headlines, the one that's all about the risks of investing in China, those risks being regulation, geopolitics, the role of the state, governance you put in there as well. For us at Baillie Gifford, we want to widen those inputs to make sure that we're not ignoring the deep real-world forces that are reshaping industries supply chains, and consumer behavior. So the China Growth Trust is designed to capture that next wave of growth, but it does so by investing selectively and focusing on individual companies that are aligned with these long-term structural tailwinds. The rise of the middle class and domestic consumption, automation and advanced manufacturing, green energy and climate transition, innovation in software and AI. We then seek to avoid the areas where we see structural weakness. So questions of property and state-controlled financials, we can just avoid them and concentrate our efforts on the innovators shaping that future. We're very fortunate that we've got a team that combines on-the-ground insight from Shanghai, but with those global perspectives from here in Edinburgh. And a process and philosophy that brings this long-term 5-year investment horizon that allows us to look through some of the short-term noise and just focus on the operational results of the companies in the portfolio. So yes, we will acknowledge China's market can be volatile and is often opaque. Regulatory shifts can be far more sudden as a result of China's governance structures. And geopolitics is going to weigh heavy on foreign investors' minds. But we can't let those blind us to the opportunities that China's giving us. So I'm going to end back where we began. If we are looking for growth giants, then we can't ignore China. For decades, investors went there just looking for cheap manufacturing. But today, they're going there to see the future being built in AI labs, electric vehicle factories, and the apps that define daily life for billions of people. If you want to see the future, go to China. And the China Growth Trust, we hope, gives investors a way of being part of that future. I'll stop there, and I'll see if any questions have come in. Thanks, Joe.
Perfect. Thank you, Ben. Really, really appreciate that. And yeah, really insightful update. But we have had a fair few questions come in, so I think we could just jump straight into that. You did touch on several real risks to China in that presentation then, but we've got a few questions around what you think the key risks are. So perhaps let's delve into one more specifically and start with property. It's clearly been an issue for investors and weighed on sentiment towards China over the last few years. Whilst Baillie Gifford has only minimal exposure to that sector, can you give us a bit of an update and an insight to what's going on and whether you're seeing genuine signs of recovery or if real estate is really an area that we should still be avoiding?
Yeah, thanks, Joe. I mean, it's clearly a sector that is in a difficult place. And again, there's a slight danger here of sort of taking these broad brush macroeconomic generalisms towards China versus our very specific bottom-up approach, and hence not investing in the companies that are involved here. But as part of that broader macroeconomic shift that we talked about earlier on in China's economy, we've seen years of overbuilding. You've got high leverage in the sector that was met with this regulatory tightening 3 or 4 years ago. And as a result, developers are struggling. And on the back of that, a lot of local governments that typically didn't use taxes to fund themselves, they used land sales to fund themselves. So there's been a knock-on impact of the property, not just on household consumption and people's wealth effect, but also in terms of local governments and their ability to spend. And that structural adjustment is not something that will be solved quickly. Now, we have been going through this for probably 4 or 5 years already. So to some extent, we're closer to the end than we are the beginning. It's going to take a multi-pronged approach to this. So, finishing existing projects, clearing bad debts, restoring confidence, shifting to more sustainable housing and reforming the main underpinnings of what the problems were. It's also, out with the property sector, an important thing to then drive other parts of the economy that will offset the drag that we are seeing from property. So to some extent, the alternative elements, as I've talked about, consumption, services, innovation, that's really where the economic limelight is moving to help offset some of the challenges in property. But every time we get monthly numbers in property, they still don't look like they are improving, and there's probably further to go there. There's one final interesting angle I think that's worth bringing out, and again, this is with a much longer term lens, but if you think of China's closed capital markets, money's very difficult to get out of China. There's about $10 trillion of excess savings there. So people have the money, they just don't have the confidence to spend it. But where do you put your money? Do you put it in property as in the past? Not anymore. Do you put it in gold, which is at all-time highs? Do you put it in bonds, which are currently yields at decade lows? Or does the equity market start to become a place for more sustained both wealth creation, which it hasn't done in the past, and we're starting to see regulators think like that. Now, this is a much longer-term phenomenon that should play to better returns in the equity market. But I think it's quite an interesting one, which is the flip side of what's happening in property, is it's getting regulators looking at how it can internationalize and institutionalize the domestic stock market, which should be to everybody's benefit.
Brilliant. Thank you, Ben. And I guess keeping on that theme of what to look for in China and what to expect going forward, the world is talking about AI a lot at the moment, and rightly so. Could you give us a bit of an insight, really, how you and the team are looking at that in China, and perhaps how the trust is positioned, not just in the, the big AI comparators to the likes of Nvidia, but those that perhaps have gone under the radar or unnoticed by some?
I mean, there is no doubt that AI is a major long-term opportunity. It's also one where China has global ambitions and very strong government support. So again, what we've seen in the past, and we can look at it in the EV space, we could look at it in areas like 5G and telecoms, where when you get top-down policy, bottom-up innovation, and China's scale working together, China can really make some profound changes. And we know in AI that's going to happen. And if we, white papers from companies like Huawei that are sort of central to some of this transformation, they talk about adding 5 percentage points to GDP in China by 2035. Hence why the government's that excited. It has a population challenge, and that's why it's trying to turn to innovation and AI to help grow its economy against that background. And China has quite a distinctive approach because of that. It's open source, it's a big integrated ecosystem, and some of the critical companies enabling that, as you mentioned, are the big names like ByteDance, like Alibaba, like Tencent, 3 of the biggest holdings that we have in the trust. We're seeing more and more, we don't own them, they're private, but companies like Minimax or DeepSeek that are coming to the market that are effectively getting to world quality levels in terms of their large language models, but are doing so at a fraction of the price because of some of the constraints on China's infrastructure and their compute infrastructure. Then on top of that, it's not just the builders of AI, it's the users of AI. So we'd like to think that everything in the portfolio is currently thinking about, how do I use AI to reduce my costs or to grow my revenues? Tencent's just grown its advertising revenues 20% in the quarter, not by increasing ad load, but by using AI for better targeting. Kuaishou, another internet platform, has a sort of market-leading text-to-video app, which is taking off. It's called Kling, but there's a real-world application that is seeing more and more there. So I think we have to be aware of the fact more broadly around the world of concerns about bubbles in valuation. There are pockets in China where that is true, but I don't think it's run to the extent that you've seen in America. And we would think of this Amara's law as it is, that often technologies can be overestimated in the short term, but underestimated in the long term. And that's really where our sort of thinking is. But as you say, AI captures the headlines. We've been making modest reductions, actually, just to make sure that we're not all running to that one single funnel, and having a much more diversified portfolio is quite critical. But a lot of the questions we're asking all of the companies in the portfolio is, how does this make you better?
Fantastic. And you mentioned ByteDance, and we've obviously spoken quite a lot about the private space and how pivotal that could be for China's growth. Baillie Gifford has the ability to access private companies, right? So it would be fantastic if you could give us a bit of an insight into how you go about that, what that process looks like, and why you think a small allocation there is supportive. Because, as you said in the presentation, the private sector seems to be such an increasing engine of growth for China.
It is, and I guess there's a couple of broader factors here. I mean, Baillie Gifford have a far broader suite of products across our international and global mandates, such that the actual amount of assets we manage of Chinese equities is really quite significant. That, alongside a reputation for being long-term supportive shareholders, is really very helpful for access. So when you talk of one of the risks in China, access is one of the challenges, language is one of the challenges, but being on the ground with a reputation for being supportive, both in the private and the public space, is really quite helpful. And what we find is that gives us access to some of these growth companies far in advance of others. ByteDance, as you mentioned in the trust, is one we've owned for quite a long time. Our second holding is a lot newer. Xiaohongshu is the name in Chinese. It's called Red Note. In the West, another app. It's very quickly built itself to 350 million monthly active users, and is just at the very early stages of its monetization story there, not just in China, but going out with that. So our eyes are open, I think it's fair to say, to the excitement that many of these private companies who are staying private for longer. In the old days, companies would have gone private at $10 billion, $20 billion market caps, and we've got ByteDance at probably 300 plus, now continuing to stay private. So our focus is across that spectrum. It's great that we can own it across both the public and the private space.
Mm-hmm.
We are looking for investments in the private space, but we're also looking at private companies, perhaps that we wouldn't own, but are competitors to things that are in our portfolio, not just in China, but globally.
Mm-hmm.
And again, in some of these spaces, there's really quite a lot of companies that might not necessarily be making profits today, but could be significant competitors globally. So there's a number of angles of why we think it's critical to do that, and certainly why Baillie Gifford is putting an increasing amount of resources behind our private capabilities.
Brilliant. And I guess kind of feeding off a little bit to resource behind Baillie Gifford, given China is featuring so much in our dialogues, and it's kind of the resurgence over the last 12 months has really put it back on the map for some investors. How well do you think the trust itself is being marketed, particularly to retail investors?
I think we have to take this almost in chunks.
Mm.
And again, sort of Baillie Gifford have been managing the trust for 5 years now. And it's fair to say, and I think some of our listeners, people dialing in today, those early investors in the trust, it's been quite a painful journey.
Mm.
Performance in those first 2 or 3 years was very, very difficult for a growth manager at a time at which both value, state-owned enterprises were doing very well. And again, a long-term focus, but a significant focus on governance and alignment is quite important to us. But during that period, it was the kind of companies in state-owned financials that were doing very well, not the kind of things we typically get excited about. So, China was off people's agenda. People were saying it was uninvestable, and there was very little demand for China as an asset class more broadly, not just the trust. Throughout that period, I don't think our philosophy has changed. So the investment managers have continued to do what they do best, which is trying to find the companies for whom fundamentals on a 5-year basis look exciting and stay true to that investment thesis. We're not tactical. We're not throwing it out saying, let's invest for 6 months in state-owned enterprises with poor governance in low growth areas. Because a philosophy that clearly states we're looking for the highest growth companies is something that we stick to, because over the 30 years we've been investing in China, that's played correct. It requires patience, and that can be painful, as many of us on this call will have appreciated in those early years. But that's what I think is now quite exciting, that we've seen this inflection point, both in the understanding of China's role in the world, politically, economically, and increasingly as an asset class, as people come back to, wow, look at the levels of innovation here, and look at the other side of the coin. But also just in terms of what opportunities China is now bringing to the table in terms of those companies. So, I've now looked at China for over 20 years. Back 20 years ago, you didn't have the breadth of exciting opportunities that you have today. And I think you have to acknowledge, if your focus is on the best companies in the world, as China is increasingly giving us some of those opportunities.
Thank you, Ben. And I guess really focusing maybe a little bit more broadly now onto the backdrop of China and the outlook, had a really interesting question actually come through. If we were to invest in one market in the Far East over the next 5 to 10 years, would it be China? Would it be Japan? They're both markets that, have been getting a lot of attention over the last year or so, and have got those exciting alternatives to the US tech. They're innovating quickly. They've got really exciting things going on at an economic level. So it'd be good to get your thoughts on that.
I have to say my knowledge of Japan and the investment merits there, and the opportunities are fairly limited. So I sort of couch my broader assessments of individual markets. So, clearly for us, China plays a pivotal role in themes that are going to be central to everybody in coming decades. So that's not to overlook what is going on in Japan, but I think Japan is a very different story. Its aggregate economic development is very different. The role of currency and its role in the world is very different to China. So as growth investors, we get excited about the levels of underlying growth that we can get in pockets of the Chinese economy. Now, it would be wrong not to reflect on the higher risks that come with that. And again, we're looking at the bottom up and trying to avoid some of those big, broad macro risks. But there is no doubt that geopolitical risk and geopolitical risk premia will be quite volatile over time. There is no doubt that the dominance of the retail investor in China's domestic markets will mean that volatility is far higher in China than places like Japan. So to some extent, we probably go back to the heartland of investment theory, which is just a diversified portfolio which gives access to each of these broad themes is important. In a China context, it's just a recognition that its role in the world and its role in terms of delivering companies that will be critical to the world doesn't seem reflected by the amount of allocation it has in people's portfolios. Mm-hmm. We know why that is the case looking back in the rearview mirror for the last 3 years. And I guess aptly with this conclusion side here, are we looking through the right lenses to be able to spot those opportunities? Because it's fairly clear that people are very well aware of the risks.
And I guess on those opportunities, Ben, just to take it one step further, Liberation Day happened and we saw discounts across the sector admittedly widen. I think it was Baillie Gifford were around double-digit territory at that point, but since then discount has come in quite meaningfully, supported by the NAV, the real strong performance that we've seen both market but also the active performance that you guys have achieved. If you could talk to us about what the discount is now and maybe some thoughts around, scope around it widening, scope around it tightening further, and just give us a bit of an outlook on that.
Yeah, the discount's sitting at about between 9 and 10%. I think when I last saw it, it was 9.5%. It fluctuates predominantly based around asset class. So if you look at the trusts in the sector, they typically tend to fluctuate very similarly around that. And they will, again, fluctuate a lot to do with sentiment. So again, a good meeting between Xi Jinping and Trump will alter the geopolitical risk premium overnight and have people thinking that the asset class excitements have changed. To some extent, we try to take a step back from that and go, what is our core ability here? And that is being able to spot growth companies in advance and have the patience to be able to hold them such that the operational performance of those companies drives the share price. And during times when you have these overarching macro concerns, it is really a comfort blanket to go back to the underlying operation fundamentals and say, well, look, we can see these companies growing 20, 30, 40%. We can see management and listen to management telling us everything is fine, despite their valuations going up and down on a monthly basis. And I think the same is true of the discount in the trust. When we look out, we increased the gearing of the trust earlier this year a touch, again, just to reflect some of those things. The operational performance of the companies was very strong. The valuations of those companies, what we're being asked to pay, was still relatively low in the context of the growth that was on offer. But again, just to sort of try to balance that with the other side of the coin, we don't want to push that gearing too far, simply because of those geopolitical and macro risks that we know at times can overwhelm some of those bottom-up excitements.
Fantastic. And maybe just taking it back a little bit to something you mentioned earlier about the state-owned and non-state-owned businesses. In years past, I think a lot of investors have seen, at least in the media, that there's been quite a bit of corruption in parts of China. And whether it's from a private or kind of state control perspective, how do you guys at Baillie Gifford approach that? And do you think it's a bit of a problem for investing in China?
I mean, in aggregate, in any emerging market, I think you probably have to say, you have to be fully aware of these kind of things. And that is going to be very evident in economies that are dominated by the state, like China. There is no doubt that Xi Jinping, since 2012, has brought a anti-corruption lens. His focus has been income distribution, pollution, and corruption. And therefore, I think if you look at the last 10 years, there has been a notable boost to the anti-corruption thoughts. But I would be wrong to say that corruption doesn't exist. I think that the real focus here is there are probably 7,000 listed Chinese companies. of which the trust owns about 60. So being very discerning and having an eye to not just the alignment of its stakeholders, which will include government, will include customers, will include buyers, will include shareholders, and an alignment with policy and societal goals, but also an alignment with global norms and where that fits. And that's the global lens and the insight from Edinburgh that I talked about beforehand. Those things become quite important. And when you're holding companies for 5 years plus, having that extra lens on governance is really quite critical. So I think people see governance to some extent as a risk. How do you manage against that? And we have a due diligence framework that asks these kind of questions. But again, flipping that, I think a focus on it can also be an opportunity, because we can try and find the kind of companies that lean into that are genuinely best in class, that have a proper stakeholder alignment, and then just try to avoid the ones that are in the wrong areas. And I mean, in very quickly, we looked at a rare earth company, and you'll have seen Chinese rare earths. Very exciting from an industry background perspective, from China's supply, China's dominance in the world. From an economic fundamental perspective, it was really very exciting, but it was run by a local government that had the potential to move money out of the listed company into the local state to help funding there. And that for us was just a step too far, as you say, given the governance concerns that shareholders weren't first and foremost, it was the government. And that was just something we looked at earlier this year, but it was quite topical, but an area where I think governance overwhelmed the fundamentals in that example.
Great. And I guess just one more question, I think, Ben, before we wrap up. What would you say you and the team at Baillie Gifford are most excited about now in China? And to kind of balance that as well, what is the thing that causes most conversations in the team?
So the excitement is quite broad, but it's also that a lot of what we talk about isn't necessarily widely reflected yet.
Yeah.
So to some extent, that shift from being an export-led sort of externally focused country to one which is really driven by that domestic demand, about that shift towards consumption. That's quite exciting. And I might just give you some numbers to reflect on the size of that opportunity just in consumption alone. Consumption as a part of GDP is only about 40% in China. It's about 65% in most other countries. So the world is always disappointed that China is not moving that as a percentage of GDP. But even if it doesn't move, 40% of a $20 trillion economy is still significant. And it's growing at 5% a year. So the consumption pie alone in China is growing at $400 billion a year. The whole UK economy, GDP, is growing $40 billion a year. And yet that recognition of the domestic story in China, the companies that play to that, the lower geopolitical risks, doesn't seem reflected. So that's certainly an area where we get quite excited, and that the trust is very skewed towards that domestic demand, particularly in the services space. And I think we have to be, in terms of the opposite, what worries us, we have to be somewhat humble at our forecasting capabilities on things like geopolitics. Geopolitics brings uncertainty, and by its nature, we can't manage against uncertainty. So, having a diversified portfolio, having an adaptable portfolio, having a resilient portfolio are all things that we have to manage and that are our front and center when it comes to portfolio construction. But we don't know how President Trump will wake up in bed, one morning, and we don't know how the talks will go. They could be positive, they could be negative, but that sentiment and that geopolitical shift towards sanctions, tariffs, Taiwan, they will affect sentiment and they will affect share prices. So for periods of time, that will no doubt overwhelm the thing that we care about most, which is company fundamentals.
Fantastic. Thank you, Ben. And I think that's a really interesting kind of way to end it on China. And there was something that I read personally a few weeks ago that was talking about China's resurgence. And I guess a lot of people would probably not have guessed that China would be so resilient amid such chaos and escalating tensions with the US. But as you've gone through today's presentation, it's clear that there is an increasing driver of domestic growth, and I think that's really positive. So the risk actually might be not having any exposure to China. I think that was a really important kind of ending to the piece that I read, and it gives us a lot to think about. But really, really interesting presentation. Thank you so much for taking us through that, particularly opportunities in China, but also balance on some of the risks that you guys at Baillie Gifford are talking about. For those wanting to explore the trust, or indeed China as a market more further, Ben and the team at Baillie Gifford publish a range of really excellent materials, both on the trust, but also some broader market insights on their website. So I'd really encourage you to go and check that out. And before we end today as well, I just want to say thank you all for joining. It's been an absolute pleasure to have you on. And equally, Ben, thank you so much for going through that update on China. It's equally been fantastic to have you.
Thanks, Joe.
No worries. And with that, it's time to end. So take care and bye-bye for now.